The webinar will begin in 2 minutes. The webinar will begin in 1 minute. Welcome, everyone. We are pleased that you have joined us for today's webinar titled IRS Publishes New Section 72T Rules. The webinar will last approximately 20 minutes, and at the end, you will be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter will be Linus Sugis. Linus is the president of Advanced Underwriting Consultants. He and his team answer tax and technical questions posed by producers every day. Linus also spent 14 years working in the home office of a life insurance company in various roles. He also started, ran, and sold an estate planning law practice in the Nashville area. Linus will draw on his legal and life insurance experience during today's webinar, and here he is.
Thank you, Amber. Appreciate all of you being with us today. Before we get into the content for today, talking about the new Section 72T rules, let's decide what we're going to visit about next month. Your three choices are surprises with proposed RMD regulations, free online resources to use in your business, or a big mistake with a self-directed IRA. I'm going to go open the poll and ask you to go ahead and vote for your preference for next month. So here we go. Go ahead and vote. I'll give you a few seconds to do that, and we'll figure out what we're going to talk about next month. Most votes are in. Take another couple seconds and vote if you haven't done it already. All right, we're going to go ahead and close the poll, and next month's content will be surprises with proposed RMD regulations. Thank you for that. As a reminder, we have these free webinars on the first Wednesday of every month. The time is at 11 a.m. Central, noon Eastern. They're free of charge, and so if you feel like you know of a person who can benefit from the content that we're covering, feel welcome to pass word along. And as Amber will remind you of at the end, we do record these webinars, and they are available through our YouTube page so that you can pass along links later on to those who might be interested in the content. All right, thanks for that. Let's go ahead and get started. Let's talk about the new Section 72T rules that the IRS published in its notice 2022-6. We're going to talk a little bit about the background for Code Section 72T. We'll discuss the big change that was made as part of the notice. We'll go through an example, and we'll remind everybody who's participating today of some of the questions that are still unanswered with regard to Section 72T distributions. The new ideas about 72T that were published as part of the notice really will fundamentally change the way that 72T and 72Q distributions are calculated. So let's go through a little bit of the background first to see how a little bit broader context about what has changed. So when we talk about 72T or 72Q distributions for non-qualified annuities, 72T for qualified accounts, what are we talking about? Well, we're talking about taking distributions that are designed to avoid the penalty tax on pre-59.5 distributions. We've got an extra 10% penalty tax on the taxable portion of distributions from qualified accounts or from non-qualified annuities if they are taken in general prior to age 59.5. And so what we're trying to do is we're trying to have our client avoid that extra penalty tax. And the source of most of the information that we've relied on for both 72T distributions or 72Q distributions for the past 20 years is Revenue Ruling 2002-62. And now Notice 2022-6 has changed at least part of that. Well, what did 2002-62 tell us about substantially equal payments based on life expectancy? That's the 72T, 72Q distributions. Well, what they've told us is that the IRS really has endorsed three methods for calculating 72T or 72Q distributions: the amortization, the annuitization, or the RMD methods for calculating substantially equal payments based on life expectancy. Now, the RMD method is one that is fairly easy to understand because it works in a way that is similar to how RMDs are calculated for those of our clients who are 72 or older. You use a table that has a life expectancy. You divide the beginning of the year account balance every year by the factor, and you come up with a distribution amount. That has the virtue of being very easy to calculate. The downside is that it is generally the lowest initial payout under 72T or 72Q, and that's not usually what our clients are going for. So the amortization and annuitization methods generally produce the highest initial payouts, and the payouts are level under both methods. Both those calculation methods and exactly how to calculate is a little bit beyond our 15 minutes together. But it's basically a calculation that has an embedded interest rate built into it. And in the past, based on the information that we had in Revenue Ruling 2002-62, the interest rate that we were allowed to use as a safe harbor was 120% of the applicable federal midterm rate. And if you've done any Section 72T or 72Q calculations, you know that interest rate was relatively low. In a lot of cases over the past few years, it's been between 1% and 2%, meaning that the calculated payout under 72T was also relatively low compared to the account balance. And for a lot of our clients, that ended up being a problem. And for many, because the payout amount was too low, lower than what they needed to live on, they ended up having to try to solve their income needs prior to age 59.5 in a different way. So let's talk about the big change in Notice 2002-62. Well, here's what it is. There's no real mystery about it. This has been really a positive outcome for a lot of our clients who are considering 72T. The IRS says you can now use a default interest rate of 5%. That's a lot higher than 120% of the applicable federal midterm rate, at least right now. So that's the big change. The effect is that if you're doing a new 72T calculation in 2022, the payout amount that is calculated for just about everybody is a lot higher than it was in the past because we've got a higher interest rate embedded in the calculation. Let's go through an example that kind of drives that point home. So let's say that we've got Fred, who was 56 last year in 2021 and wanted to begin 72T distributions. He would have used last year's life expectancy table and the relevant interest rate. Remember, we talked last month some about how the life expectancy tables beginning at the beginning of this year have changed, and there's longer life expectancies in the new tables that the IRS expects us to use this year and beyond. And so with a longer interest rate, or with a longer life expectancy, all things being equal, the 72T distributions under the amortization or annuitization methods would be lower than they were in 2022 than in 2021. But let's focus on 2021 for a minute. Let's use the old life expectancy tables, and let's use December's interest rate, 120% of applicable federal midterm rate. That would be 1.52%. And so based on those factors, Fred's life expectancy using the old tables, the amortization method would have produced the highest level payout of about $13,000 a year. That's on a $300,000 account balance. A little bit more than 4% of the account balance would be paid out under 72T or 72Q. So let's also consider what would happen or compare what would happen based on the new tables and the new interest rate. And let's say that Wilma, who is 56 this year, wants to start 72T distributions, and let's say that she's also got a $300,000 account balance that she's using. She's going to use the new life expectancy tables and the 5% safe harbor interest rate that we're allowed to use as a result of the new IRS notice. Using all of the same factors that we used for Fred as of last year, but adjusting for longer life expectancy, but a much higher 5% safe harbor interest rate, Wilma's able to get a payout on the 72T calculation of over $19,000, which is 50% higher than what Fred could have gotten starting it a couple of months earlier. And so it's a dramatic increase. The 5% interest rate means that those folks who are considering 72T or 72Q distributions, who may have been frustrated in the past about the relatively low amount of those income streams, may want to take a look at this again and consider implementing based on the new 5% interest rate. The example really drives home the point about what a positive difference this makes for those people who are considering 72T distributions. Now, notice 2002-6 wasn't perfect. It doesn't answer every question about 72T or 72Q. We've got lots of things, mostly about what happens to people who have done existing 72T or 72Q arrangements. Do the new rules affect them? Do they have the ability to switch interest rates? What are they supposed to do with regard to the new tables? Is anything positive happening for them Does this new rule only affect those who are doing 72T going forward? And the service hasn't answered that question directly. They expect to do a full update to Revenue Ruling 2002-62, and that will happen sometime. We just don't know when. Notice 2022-6 only addresses some parts of 72T and 72Q. We expect a fuller revenue ruling sometime later. As I said, we just don't know when. And so that's still unanswered from our perspective. Stay tuned, and we hope to get that answered at some point. So what are the conclusions to take away from today's webinar? First of all, we've got new tables to calculate substantially equal distributions for qualified accounts and non-qualified annuities. We've got a gift from the IRS of a new safe harbor interest rate of 5%, which will yield higher payouts under the amortization and annuitization calculation methods, and that's good for our clients. And we don't know yet whether this might affect existing 72T or 72Q distribution setups. We hope that the information there is positive, but I wouldn't hold my breath. The IRS has already given us a gift with the 5% used to calculate new 72T distributions. I'd like to thank you again for joining us here today. And at this point, I will turn the program back over to Amber to close this out. Amber?
Thank you for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Feel welcome to join us for the next webinar on the first Wednesday of next month, which will be May 4th at this same time. Next month's webinar will be titled Surprises with Proposed RMD Regulations. You can also find an archive of past webinars on our YouTube channel, Advanced Underwriting Consultants. Please subscribe to our channel. It helps us to keep making free webinar content. Today's presentation will be posted on our YouTube channel by the end of this week. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again and best wishes for continued success.